guys, welcome back to Tax Q&A. In today's video, I'll be answering some of the most asked questions about TCS or tax collected at source. So let's get started. Tax collected at source. To understand this, we'll have to go all the way back to the 1980s. Back then, India's economy had a bit of a challenge. Some trades, especially in industries like liquor, forest produce and scrap trading, were flying under the radar. There were a lot of cash dealings, but not much of it was making its way back to the government as tax. So, what did the government do? They asked sellers to collect a fixed percentage from the buyer as tax when the goods were sold and deposit it with the government. This was called TCS. By collecting TCS, the government could track these transactions and also gauge the incomes of such buyers. Now, as the Indian economy evolved, so did TCS. Over the years, the scope expanded to cover other high-value transactions like luxury goods, cars, foreign trade packages, and remittances. So, if you can afford to spend on such big-ticket items, this is how the government makes sure your taxes are in check. When it comes to TCS, the seller collects tax from you at the time of purchase. So, if you're buying a car worth Rs 11 lakhs, the seller will charge an extra 1%, that's Rs 11,000, and deposit it with the government on your behalf. On the other hand, TDS, tax deducted at source, is a cut taken from payments you receive, like your salary. Simply put, TCS is the tax collected when you spend money and TDS is tax deducted when you earn money. Yes, TCS applies to money you send abroad, but only if you're sending more than Rs 7 lakhs. Now, the TCS rate depends on the purpose for which the money is being sent. For general purposes such as investments or personal expenses, TCS is collected at 20%. For remittances related to education, TCS is 0.5% if funded by a loan, or else 5%. Lastly, if you're sending money for medical purposes, TCS rate is 5%. So, when you're booking that 7 days, 6 nights Europe trip, you'll have to pay 5% TCS for amounts up to Rs 7 lakhs and 20% for anything above that. This includes things like international flights, hotel stays, and other travel-related expenses bundled together. However, here's a hack. See, standalone purchases don't attract TCS. Hence, if you book your flights and hotels separately, it will not be considered a tour package, and TCS will not be applicable on such bookings. Currently, a 20% TCS is applicable on international spends via forex and debit cards once the amount crosses Rs 7 lakhs in a given financial year. However, those made via credit cards are still exempted from TCS. Yes, you can. See, TCS is applicable when you spend money, and in those cases, you're already paying indirect taxes. For example, when you buy a car, you're paying the applicable taxes in the form of GST. Hence, TCS does not form a part of your actual tax liability, and you can claim a refund of this amount when you file your ITR. Just make sure to double check that the TCS is correctly reflected in your Form 26AS. And remember, if you have any outstanding tax dues, the TCS will first be adjusted against those. Once that's squared away, the difference amount will be refunded after your ITR is processed. And I guess we've covered it all. If Google search is too much work for you, Quora is full of opinions, then you should check out Tax Q&A, where you can toss questions and our tax experts will give you quality answers. And hey, don't forget to like and subscribe so you do not miss out on what's coming next. Catch you in the next one. We will do it when I say it. All the way back to the 1980s. Let's go all the way back to the 1980s. Did I say 1980s? I'm just too smart. I can't fumble. That's not expected from me, from my loyal audience.